Hey, Bobby, welcome to the show. So great for my partner to join me today. And hello, everyone out there. How you doing, buddy?
All right, Mitch. Doing great,
How you
man.
doing, buddy? Huh? You doing good?
Hey, bro. Hey, bro.
Oh,
You
bro,
like
bro.
it, Mitch?
How about them Yankees, huh? Oh, man.
Oh, man. Starting off with a bang, huh? Oh, how about them Yankees? Yep.
Oh,
That
boy.
team's going to fall apart. Everyone's going to go their way, and, you know, then they'll be in the rebuilding phase with everyone else. So, but,
Oh,
you know,
man.
such is life. They give it a good run.
They give it a good run, and
Yeah.
we'll see. So we're going to talk about your money, your vote, or is it your vote, your money? Either one, it's your vote, your money. And a lot of people are saying things to me. I don't know if you're getting this. Well, we'll see about the election. I'm thinking about buying this stock or that stock. Well, and I talk to people about it. They say, oh, well, we'll see how the election goes. We'll know. Hopefully the right person will win. I don't really know who people are saying who the right person is, and I don't actually want to engage with a lot of people about that. What do you mean who the right person is? No, it's not really something I want to get into. My thing here is, and your thing is, to help our clients navigate financial markets and take advantage of every legal opportunity we can find to help them earn more money or keep more money or save more money or some combination of those, and to not take too much risk to earn a return. That's kind of it, no?
Right. Yeah. I mean, look, our money should not be used as a weapon, an emotional weapon, right? To gauge your views or to project your views on a market that does not care about your political views, right?
Right.
So oftentimes we talk to clients who are so emotionally charged about the election and who the candidates are and where whether it's going to go their way or not their way, and using their capital, their invested capital, that's designed to be a means to their end as an emotional, as a weapon. It thankfully, I don't, and you probably don't either, have clients who act that way. But
No.
I'm sure that there, are many out there who do. And our advice is, look, remember that the outcome of the election, right, is no reason to act emotionally. That's how investing errors
Right.
and mistakes
You want
are
to
made.
keep your cool.
Keep your
You want to be Montel Williams. You want a cool head for hot talk. Remember that?
Montel.
Remember that? I'm going to roll a quick intro, and then we're going to talk about why we don't suggest to anybody that you make changes to your investments and your financial plans just because of an election, of which we're going to have another one in 4 years. And that's
Mhm.
come up quickly. We're going to forget about this one. So here's the intro. Be back in a couple of seconds. Folks, while you're watching, if you have any questions, please ask in the comments. We will see the questions. We would love to answer your questions. It's us, it's the best part about doing this. So here we go. Right. I couldn't really see the intro, so hopefully the whole thing played, but that's okay. All right. So, bottom line for me, when people say, "Should I make any changes?" I'm going to say no, because if you think one sector is going to go up, or the stock market's going to go down or up, whatever, small caps could do well, or maybe it'll be all about mid caps. The idea for us, to me, and you is and our clients, we're diversified. So whatever happens, we're going to win in one way, maybe lose in another way, but ultimately we do expect our choices to work out. Is that a
Mhm.
good way to put it for you?
I think I think you hit the nail on the head there, Mitch.
Yeah.
I think you hit the nail on the head there.
And diversification is a strategy that we use to mitigate risk, but it doesn't necessarily protect your portfolio from going down in a generally down market. Got to get those disclaimers in.
Yeah.
So
If I could just
what are you advising people?
yeah. So the conversations I've been having are um, we run financial plans for clients and we have a targeted rate of return based on the outcome of their plan. And this year in particular, we are fortunate enough to have, you know, had a market that's cooperated, that's done exceptionally well. And for those clients that perhaps don't have as long of a time horizon ahead of them as others, this has been a good time to really kind of maybe assess where we are in historical returns compared to what we are targeting in our financial plans. And if we're above target, I've been selectively taking some profits in order to lock in gains as we go into a period of perhaps uncertainty. But that's driven purely by not the emotional reasons, but by uh, logical and rational financial planning.
Right. Rebalancing is something that we think is important. In the last couple of years, excuse me, still trying to get over the cold that you gave me 2 weeks ago. But
The gift that keeps on giving, Mitch. I love you so much, man.
you know, people have been reluctant to rebalance because they see all the money they're making in the stock market and people feel good about it. The hardest time to rebalance is when the market's up a lot or when it's down a lot. Those are the hardest times to rebalance.
Yeah.
And then the easiest time to forget about rebalancing is all the time. So unless somebody is there strictly enforcing a rebalance, it usually doesn't happen. That's where we come in as accountability coaches to our clients. So that's one thing. I would like to say that I'm hearing all kinds of things. Uh, Oil stocks could do better under a Democrat or Republican uh, administration, which that evidence is so mixed that there's no truth to it whatsoever. The more oil you pump, that could be good for pumping oil, but bad for energy stocks. If you restrict pumping, that could be good for energy stocks, as these things trade on scarcity or abundance. Same thing with healthcare. But I'm looking at the charts, and over time, both those sectors have done very well, in particular healthcare. And it hasn't really made a difference who's the president. Just really the thing is the demographics as the population gets older, we're using more drugs, creating more opportunities for drug companies. And every now and then you get a killer class of drugs like the GLP drugs for weight class, which helps to lift the ones that are in those particular sectors.
Mm-hmm.
I think a bigger thing here is the personal finance aspect, because, whatever happens in the election, you, me, our clients, is why our clients use us. They still want to retire one day. They still have to invest to earn a return above the inflation rate. They still need to have an emergency fund. They still need to be properly insured, either health, life, or goods or possessions. That to me hasn't changed. So when I take a look at this, is it still worth doing a Roth conversion? Is it worth, at the beginning of 2025, is it worth increasing your contribution limit, what you could put into your 401k, because the limits are being raised just a little bit for 2025?
Yeah. I mean, every situation is unique, right? So to paint
Right.
a wealth conversion strategy with a broad stroke of the brush, not something that we do. Everyone's situation is
Everyone's unique.
It's very hard to project what tax rates are going to be in the future. Keep in mind that you need time ahead of you to recoup that upfront tax that you've paid through a
Right. When
Roth
you convert, right. When you convert the IRA to a
conversion.
Roth.
That's a very
Mhm.
highly unique conversation to have
But
with.
these are the conversations that are worth having. Not, should I sell everything and go into
Yeah.
cash
Right.
and wait
Right.
for the election to pass us by and then get back in, because people are waiting. Either they're scared about the election or they think that they're going to have some kind of magical drop in the market. They're going to swoop in at the exact right time and make a killing on the market.
Yeah. Yeah.
Think about how long it took people to get back into the market after the 2000 tech wreck and after the Great Recession that bottomed. The bear market bottomed in March 6th of 2009. And it took people a long time to get comfortable with stocks again. And some people were knocked out of the stock market, permanently because of their own fear.
Yeah. Yeah. No, I think, having a prudent approach, I think this is a year where it's been very easy for people to maybe be over risked in their portfolios because
Yes.
it has been a relatively complacent stock market.
Talk to somebody about taking profits on the Magnificent Seven stocks. They don't even want to hear the conversation. Look at you like you're crazy. But oh, it's artificial intelligence.
Yeah.
The problem with thematic investing, and every couple of years we have a great theme, is that once you get into a theme, investors can't think of anything else to do. So what's the theme? Well, if you're not going to buy NVIDIA, you'll buy some second or third tier semiconductor stock that could come out with a chip for artificial intelligence or something. Right. But nobody's getting out of the sector looking at other things because it can't. We have themes: internet, artificial intelligence, some maybe healthcare, but in between these themes, there are other stocks to invest in, be it financials, industrials, utilities. And I think that is a much bigger thing to think about than how than who's going to win, if it's going to be Trump or Harris in the election.
Without a doubt. Yeah. I mean, the markets are, people don't give the markets enough credit. They think that whoever is in office kind of dictates the, how profitable companies are going to be, or that they can, use a sledgehammer of legislation to either make or break sectors. Companies are much smarter than the government is. All right, that's a newsflash.
Right.
And I'm not the first one to say that, and I won't be the last one to say that. That good companies with solid leaders at the helm in industries that are growing are going to benefit and flourish regardless of who is in office, because they are the ones who create value for shareholders,
Right.
not the Mr. or Mrs. In the Oval Office, and that's just a fact.
Just a fact.
And that's just a fact.
A
So,
couple of things I want to touch on. I think the two big things that investors worry about, getting out of a lot of rhetoric, but taxes, tariffs are two big headlines. So the tax situation, you and I have talked about this a million times.
Yeah.
After 2025, so one more year, and then the Tax Cuts and Jobs Act is set to expire.
Right.
Now, some people will look at that in a different way. Whatever. We're not here to debate good or bad. That was legislation. It was made to expire at the end of next year, at the end of 2025. And I think if you're selling a business, you're doing some estate planning, you've got an opportunity to get a lot more money out of your estate now because of the estate planning rules. I think those are the bigger things to think about than, will drug stocks or artificial intelligence stocks keep going up. People think there's some kind of magical thing.
Yeah. Well, I mean, for the majority of our clients, and for the majority of everyone out there who is listening, the estate tax sunset is probably not the most important thing on people's minds with respect to what's expiring at the end of 2025. And let me go into a little bit of detail with respect to what I mean. Um, the standard deduction came into play as a result of the Tax Cuts and Job Act. Before that, we had the ability to itemize our deductions. When they put that into legislation, they increased our standard deduction for joint uh, for people who are married filing jointly. 2025, the last year of the Tax Cuts and Jobs Act, that standard deduction is going to go to $29,200. Assuming that it expires, that's going to drop down to $16,600. So then that means that we'll have to find more deductions to get us back to what that standard deduction was. Can we do that? I don't know.
And for people who don't own a home or don't own a business
in taxes,
the standard deduction's been a really good thing for a lot of people.
Sure. And that's going to be a bigger issue, right? Is our tax rates going to go up? They cut the top tax rate from 39.6 to 37. That may go back up to 39.6.
It's expected to at the end of the when this expires and the Tax Cuts and Jobs Act.
And then the SOLT, right? State and local tax is also obviously a hotly contested item in California, New Jersey, and New York.
It's a big coastal issue for sure.
So those are the bigger issues, I think, that are going to affect majority of everyone out there who is tuning in today, as well as our clientele. Over and above, is the lifetime exemption for estate tax is going to drop from $26 million back down again. And if so, I think on both sides of the aisle, they see a benefit to extending that, but it's going to require compromise. It's going to require spending cuts somewhere else. It's going to require increased revenue somewhere else.
Look,
so
we could talk about the policies, child tax credits, and those are the things. But we're just want to keep it to the investing part. If you're somebody who's, and by the way, people watching this, if you have a question, if you're watching the live or the replay, ask in the comments. We'd love to see the question. We'd be happy to answer that. I think if you're somebody who's investing in a bunch of index funds, small, mid, large cap, and some bond funds, the conversation is irrelevant whether or not you should be making changes to your investments, I feel. Because if your time horizon is 15, 20 years, even if you're retired, even if you're, don't be insulted by, I'm going to say this to anybody out there, if you're 80 years old, you still have a time horizon, hopefully, right? You still have to say, well, what if I live till 90? So,
yeah,
or my spouse, or or I want an extra cushion, so I want to make sure I make as much money as I can within reason of my risk tolerance. So these things, these concepts are not, they're not going away. All right, you still want to invest, and I don't think you should be making a change based on that. I want to talk about tariffs now. The other big thing is tariffs. Trump implemented tariffs. Biden actually maintained those tariffs. And I think the conventional wisdom is tariffs in some cases could be a useful tool, but not good for a blanket, tariff on every single import that comes into the United States. So, the policy of tariffs to me is going to hit a lot of consumers who are, let's say $150,000 family of four would get hit pretty hard. If they're making $150,000 income, family of four, a rise in tariffs would hit them pretty hard, and their tax bracket based on standard deduction and what the brackets are, they're not really paying that much money in taxes anyway. So even if you give them more of a break on taxes, I don't know if it's really enough to make up for the hit that they're going to take on the tariffs. That remains to be seen. But these are the kind of things that could impact the markets. Maybe you think companies that rely on exposure to foreign goods, things like that, which is almost every company, by the way. And then you have to see if we have, not just a Republican or Democrat president, but what's Congress going to look like? These are unknowns, and I don't like making changes when I know that 10 years from now we're going to have a whole new set of problems,
Right.
and 12 years from now we're going to have a presidential election that is going to be considered the most consequential election of the nation's history, just like everyone has been before it.
So here are two useful pieces of information, I think, unrelated to the last couple of, minutes of conversation. Secure Act 2.0, right? There were a lot of provisions that came into effect with Secure Act 2.0. One that goes into effect January 1st, 2025, right? You've heard of the catch-up provisions in 401ks and 403bs, right? So go ahead and explain to our audience what the catch-up provisions are.
Well, if you're over 50, okay, like I am, you get to add more money to your retirement plan or your IRA or your 401k, your 403b. So if you make the money, you could do it.
Right. So starting in January, for those that turn 60, 61, 62, or 63, you can defer $11,250 over the $23,500 standard contribution amount to a 401k plan. So what does that mean? That means over and above the $7,500 catch-up provision, right? Clients that turn 60, 61, 62, or 63 can contribute, instead of $7,500, an extra $11,250 to their 401k plan. That's going to help to reduce taxable income on pre-tax contributions, and it'll give them a little bit of a boost to beef up their retirement plans in their peak earning pre-retirement years. I think that's a huge piece of information.
Right, absolutely. I wish I'd added that in my.
The other aspect, especially in a year where we have huge gains in the market, for those clients that are invested in mutual funds, we're getting close to the time when mutual funds release their capital gains. Okay. So these are embedded capital gains that are going to be distributed to shareholders of certain mutual funds. How do you know if your mutual fund is going to have a capital gain distribution or not? Well, for us, what we do is we contact all of the mutual fund companies that our clients own, and we ask them, do you plan on distributing capital gains to shareholders? That gives us the ability to sell, right, shares of the mutual fund and reinvest those assets into maybe a similar strategy, so that our clients don't get an additional capital gain distribution on top of what they may have already received upon the sale of those shares. So it helps to eliminate maybe an extra capital gain distribution in perhaps an already high capital gain exposure year as we have. Tell me your thoughts about that, Mitch.
I'm someone who has not used a new money into a mutual fund. Maybe 20 years. I basically the mutual funds that my clients have, I'm talking like old legacy funds
Mhm.
that they've had for many, many years. We don't even know the cost basis to these things anymore, but luckily they're in IRAs, so it's a qualified account.
Right. If they're an
And
IRA, it's a moot point.
and sometimes they're worth holding on to. Most of them I have gotten out of over the years, and I've replaced them with exchange traded funds who, when it comes to uh, tax efficiency,
Mhm.
ETFs are much simpler and hands down, I think, are a much better tool, in my opinion. And these are just tools. So maybe your favorite tool is a screwdriver, maybe my favorite tool is a hammer, but we have a set of tools. Mutual funds are in that set of tools, stocks, individual stocks, and ETFs. But when it comes down to it, I do prefer the ETFs or individual stocks over the mutual funds. It's just my style
What
of
would you
investing.
advise a client that came to you who's not a client and has a portfolio of mutual funds?
If they have like substantial capital gains embedded, and they're of an age where, let's say, their heirs could inherit them at a stepped up cost basis. In a lot of cases, I would say you might as well hold on to those. In
Mhm.
some cases, fund companies will allow them to switch to a lower cost version of the fund. Sometimes, in particular, if it's in a fee based account, if it goes into a fee based account. And in some cases, I'll say, let's stop reinvesting into that fund and the money that instead, reinvest into something else.
Mm.
But that I think is a big one. But other than that, really, somebody comes to you with a couple of $1 million of mutual funds that they paid very little money for, and
Yeah.
they've been in these funds for the last 40 years. You don't even know what the cost basis is. It's almost like you can't even sell the fund because the accountant is going to ask, their accountant's going to ask you, what's the cost basis? You're just going to have no idea, and everybody's going to be mad.
Yeah. 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 I mean, so for those who haven't owned a mutual fund for 40 years, um, if you have a fund that you bought maybe a year or two ago, or even 3 years ago, and you've had years of appreciation, just be aware. And this is for our listening audience who are not clients, who don't have accounts with us yet. Um, we can certainly be an asset and help you to determine, by contacting the funds directly, because we know who to contact and what questions to ask to make sure that you go into the end of the year with your eyes
Right.
wide open and you're not hit with a surprise capital gain.
And calling the fund companies is helpful. Sometimes they don't have it if the funds were held in street name. If they're held directly with the fund company, it's a snap. It's very easy to do. But if funds were held at like another firm and they transfer it to us, the other firm probably doesn't even have the cost basis. Also, uh, one thing you could do is if you are planning to make charitable donations, you could give some shares of the fund away directly instead of giving away cash. So at least you got rid of the fund, which you would have given that dollar amount away anyway. And now you have less money in a fund that's maybe not as tax efficient. And you can invest into something else with new money coming in.
Hmm. Good advice.
So lots of ways to figure things out. And Bobby and I are very creative with this stuff. We have wonderful resources, and we've got a really good just a group of elite people that we are in touch with in different areas. So I think it's fair to say our bottom line is don't be making any hasty changes because of the election. It's probably not the right thing to do. You probably are just looking at emotions, not logic. We don't think investing should be based on elections. We don't think you should be making swings into one sector or the other. Now, if you're somebody's trading on your own, you have your own side brokerage account, have fun with it. But we're talking about people's serious money. That's a serious part of their net worth for their serious retirement. We counsel hang out, don't make any sudden changes. If there are opportunities to improve your estate plan or your tax situation, we will take advantage of those. But even with that, it doesn't mean you change your investments. It might just mean you're changing the location of your investments from an individual account or an IRA to a Roth or a 401k. Maybe you'll start with a Roth 401k plan at your office at work instead of a traditional 401k. I think these are much more important things to think about, the things you can control, and just don't even worry about the things you can't control.
Couldn't agree more. I think you said it all. You said it all, Mitchell.
All right. So we're on for a half hour, believe it or not. So I think that's enough. If you have a question, reach out to us. If you have any questions, and ask us in the comments. We love hearing from you. I'll end the broadcast now, and I'm glad we did this, Bobby. Thanks so much for the time.
I'm glad we did too, Mitch. It's been
Bobby's on the other side of that wall, right behind me. So we're in the same office. We have very different tastes in decorating. Okay. I'll see you in about 30 seconds after the show.
Take care, everyone.
Bye.